Hello, folks. Dan Bird here on Sunday, December the 10th. I'm sitting in. Mr. Zuber's not here today, and I am flying solo. So I'm just going to do one recording on this Sunday just to talk about the market, where it's been and where it might be headed next week. And then I want to show you something kind of interesting as well. So let me share my screen and we can jump into it. Here's the website for those that are interested. I put out a newsletter every Saturday usually, and it's free. So you just come here to breakpointtrading.net and click on this button here. You can get the free newsletter. There's a lot of content, which I'll show you some of this, but that does require a subscription. But there's lots of information right here that does not require a subscription. So the IBD status right now is still market and confirmed uptrend. This is since November the 15th. So that's good news. We can take a look at the S&P right here. The S&P broke out of 4,600 just barely, but that is a very important level. You can see that goes back here to July. This was the high before the sell-off from July. The March 2022 high is right above it. So we'd like to see that go up and take out that resistance level as well. I'm going to show you what the all-time highs look like in a minute, because that's the interesting thing that I want to show. But right now the market is very bullish. However, it is extended. I've talked about before the last couple of weeks that I'd actually like to see a pullback, but it doesn't look like it's going to. Looks like it just wants to continue higher. The momentum indicators up here, the RSI relative strength, is pretty firmly up in the bullish territory, although the money flow is starting to decline. So it might be an indication that that pullback might be coming here soon. We'll see. But everything else looks pretty good. If we look at the NASDAQ, again, looks very similar, broke out of the resistance level. There's a gap down here, but that doesn't mean it has to fill. It might fill it next year or 2 years from now, whenever. Same thing with the RSI. Relative strength is still bullish, even though it has a little bit of a negative divergence. So you can see that it's making lower highs, even as the price stays steady or is actually making higher highs. So when we broke out of this resistance and hit a new high right here, the relative strength did not hit a new high. So that's an indication that the momentum might be slowing down a little bit. Still pretty bullish, but something to watch for. And keep that in mind when I show you something here in a minute as well. Bitcoin continues just to climb higher. I mentioned I think last week, that 41.3 looked like the next target is going to go for. It was down here somewhere around 38,000. And it certainly not only got to that, but it blew right through it. So it's up around 44,000 now. Very interesting with Bitcoin. Of course, the ETF that's being announced, I think, it's contributing a lot to that. So we'll see if it continues higher. Looks pretty bullish right now, though. The US dollar started to make a little bit of a comeback and then gave some of it back Thursday, but then rallied again on Friday, probably off of the good jobs number. Gold hit those highs right there and then started to pull back. So we'll see if gold can finally break through. This is a multi-year resistance level where gold is right up here. So if it does break through, especially with volume, that's a really important level for gold. It could significantly take off if that happens. 20-year bond is still moving higher. The 10-year yield is moving lower, even though it too had a little bit of a bounce Thursday and Friday. But I think it's going to probably continue a little bit lower as well, probably down to 4%. So that's where that is. Let's take a look at real quick. First, I'm going to go and take a look at the newsletter for this week, because actually that's the newsletter for last week. Newsletter for this week should be this one. Yes. Not sure why that's still showing that. But at any rate, last week we had the jobs number came in at 199,000. It was forecasted, actually, the day of the number, it was forecasted at 190. It had hit 199, so a little bit higher, but not a lot higher. Interestingly, though, the unemployment rate dropped from 3.9 to 3.7. That's really important. Keep that in mind. Coming up next week, and we'll take a look at this, is the CPI number is the most important thing, and the Fed meeting as well. CPI is on Tuesday. Right now, the core CPI is forecasted to tick up slightly, and then headline CPI to tick down just slightly from 3.2 to 3.1. So we'll see if that happens. I think that's probably pretty accurate. I think the next 1% to try to get to 2% is going to be really difficult. This is the hardest 1% to get through. Right now, there's reasons why this should probably be stable. I mean, I wouldn't be surprised to see it right at 3.2, the same as last month. 3.1, I think, is reasonable. Next month is the one I'm worried about, and I'll show you that here in a minute. And then the Fed meeting is the very next day on Wednesday. The expectation is that they will not raise. So they'll keep it at 5.5%. It's actually technically 5.33 is where it is right now. So we'll see, but I don't think there's any expectation that the Fed will raise. They'll probably just keep things stable for this month. Interestingly, this is something that I put in the newsletter this week, the SOM rule, which basically says 12-month lowest. Right now, the current average is then compared to the lowest 3-month average of the past year. And I'm going to show you a chart that will show this. So this is kind of indicating when the recession is going to happen. I've mentioned this before, but I didn't have actual numbers like this rule does. So we'll take a look at that. Actually, let's go there now and take a look at that on the website. Go to the chart section. Here's the Santa rally. This is something that I added. So this is the Santa rally for last year. The Santa rally begins the last 5 days of December and the first 2 days of January. So this year it will start on December 22nd. Will be the beginning of the Santa rally indicator. Now, last year, yes, it was positive, but only by 0.8%. So it wasn't a huge uptick, but it was positive. Then the second criteria is the first 5 trading days of January. In this case, it was up 1.4%. By the way, these all come from Stock Traders Almanac, who came up with this idea 50 years ago. And then the final piece is the full month of January, which this year, 2023, it was 6.18% gain. So all 3 of these were positive, even though the Santa rally was very slightly positive. But all 3 were positive, and the indicator says that when all 3 are positive, the year ends higher than it began. So the close at the beginning of this year was 38.24. I'm pretty sure we'll end higher than that this year. And I will track this as we get closer to the 22nd. I will put the chart in here for this year, and we'll start to watch that as it goes up. But let's take a look at CPI first. So here's the 12-month window. This is the one that will drop off in the report next week. You can see that gap right there is very small. So what that means is that there won't be a huge decline because the gap is small, unless commodities really start to fall rapidly. And they are falling. So while the gap is small, and that's why I said it might just come in flat, but because commodities are down, gas and oil in particular, that could cause it to drop a little bit more. So 3.1, I think, is reasonable. But look at the one the next month, the one that is reported in January. It's a very, very small gap right there that drops off. So that one could even show an increase in inflation unless commodities continue to really drop. And I'll show you that next. And then the one after that in February is a big gap, huge gap. So we might in January, the January report, get another flat reading or even slightly higher, possibly. But then the one that comes out in February is going to show a significant decline, and we might go below 3% actually in February, the February report. And that's where inflation is really going to look like it's starting to drop off a cliff. And I think that's when the Fed is going to say our job is done. If they raise, it would be in this January timeframe. If this actually ticks up slightly, the Fed will say it looks like inflation's coming back up and may cause them to provide one more rate hike. I don't really think they will, but that's the only reason they might right there. But right after that, the inflation rates are going to fall dramatically from that point forward. And that's when, in this time frame here, probably the March and April timeframe, when it's going to look like, especially right here, the March to April. So this will be the February, March, April. So the May report right here will again show inflation dropping. And that's the time frame, depending on what happens with jobs, that the Fed might start thinking about or talking about cutting rates sometime in May. Because of that big gap right there, that will show inflation falling dramatically. And depending on what the jobs numbers do in that time, so we've got, what, 5 more jobs numbers that has to come out. And I'll show you that in a minute. That's when the Fed might start talking about dropping rates in the May timeframe. Just my opinion, of course. So here's what we're looking at as we go into next Tuesday. 3.2 is where the headline is. They're forecasted to go to 3.1. It might stay at 3.2, somewhere in that range. All right, so let's take a look now at rate hikes. And this will show also the commodities. So this shaded area here is what the next CPI number will reflect. This is the November to December period. And you can see that the commodity CRB, oil, and gasoline kind of leveled off, but CRB and oil dropped dramatically. But look what's happened after that. So this is the one that will be reflected next week. The one the following month, where the CPI that drops off is not very big, but look at commodities. If they continue dropping like this, then we could be down to 3% next month in that meeting. So these are significantly huge drops in oil, gasoline, and agriculture, metals, etc. If that continues, that's going to be very good. And I think the Fed will say that their job is done. So you've heard, a lot of talk about higher for longer. Right now, we're only 2 months into that. Next week, we will extend this to 3 months. So higher for longer will be for 3 months if they don't raise. If they do raise, then we start this clock all over again. So you can see right back here was the last raise here in August. So we'll keep a watch on that and see what happens. So let's take a look at the recession watch. So these are the 3 components that I watch for recessions. First one is the unemployment rate, which was just reported on Friday. And interestingly, it dropped. So this is the SOM rule that I alluded to before. Recessions start when the 3-month moving average, which is this pink line, rises by more than a half a point above the 12-month average. So the 12-month average currently is 3.5%. You can see when it rises above the dark blue line in the previous recessions, that usually happened just 2 or 3 months before the recession occurred. We were headed there. In fact, if the rate had risen from 3.9 to 4 on Friday, we would have crossed over that blue line just like we did back here. But instead, it reversed and started going lower. So that might give us a bit of a reprieve. But if that does turn around, and this is the thing that we'll be watching for the Fed, if that does turn around and the unemployment rate starts to tick higher, crosses over that blue line and gets up to 4% and even higher than that, then the Fed is going to pivot from inflation to jobs, and that's when they'll start talking about cuts. Again, I said that could be in May, could be earlier than that even. But the Fed wants to keep rates where they are as long as they possibly can. But I think probably by May timeframe, the unemployment rate is going to be ticking up. I was at the Money Show last week, and I saw Liz Ann Saunders there, and she indicated that 4.5% was the level that she's watching. So somewhere in that 4.5% range is when the Fed is going to say, that's it. We're not watching inflation anymore. We're watching jobs instead. So we'll keep a watch on that as we move forward as well. Fed rate hikes and recessions. Previously, the Fed has always started cutting rates before the recession started. So here's 3 months, 14 months. They kept them steady. Remember, we're at 2 months, going on 3 months as of next week. So 14 months here, 6 months back here. Started dropping rates before the recession, dropping rates before the recession in each of these cases. So another thing that we will watch if the Fed starts to drop rates. And then finally, the inverted yield curve, which I've talked about before. It was heading back towards zero. The recession occurs 4 to 6 months after it goes back and uninverts. So after it goes back above zero. Happened back here, it was 6 months. Here for COVID, it was 5 months. It just barely went below zero, but it did. And we were headed there pretty rapidly. You see how fast it started moving up. And then all of a sudden it reversed. Now, last week it started moving back up again. So we'll have to keep a watch on this. And if this does go back above zero, then the clock starts ticking for about 6 months for the recession. So again, something to watch for. I put all of these into this box right here, so it's real easy to access the recession watch. Let's pivot now and take a look at the market, what the market did last week. And one thing I want to show is the sector performance for the last month. And you can see everything above this S&P line right here. We've got technology, financials always do well in the fourth quarter. We have consumer discretionary. Technology, consumer discretionary are aggressive sectors, but real estate is up there as well, which is really interesting. If we look at 1 week, however, all 4 of the aggressive areas are outperforming the S&P over the last week. That is very positive for the market. That's what you want to see. And I'm going to show you something else that's really interesting too. So this is consumer discretionary. This is where Tesla is located, communication services. This is the internet stocks like Google and Meta, and then technology. These are all the technology stocks in here. And then the NASDAQ 100. All 4 of those last week outperformed the S&P. So that's good news for the market. And I think in general, I think the market still wants to go higher. We'll see how long that lasts. It's getting a little overbought and actually needs, I think, to have a pullback. But it doesn't mean it will. It could continue just going straight up. So let's take a look at something that I was working on. Let me find the one that I was working on here. Yeah, here's this is the Santa Claus rally from last year. But let's take a look at this. This is something I've talked about in the past. And whenever the market is hitting new highs, now this is 2021. So this is December of 2021. I want to compare it to where we are right now. December of 2021, if you remember, the market was hitting all-time highs. Right here in November, had a big, huge run from the beginning of October into November, hit all-time highs right there. And then we had a pullback. And then in the first part of December, it took off and continued to hit all-time highs. Now, the reason that I covered this up right here is because this is the point that we are right now. Right where this 2021 market was, basically the weekend before, or after the first week, let's call it, of December. That's where the market was. So it had already hit all-time highs. It was flirting with them again. And everyone was pretty sure the market had just kept going up all of 2021 and the second half of 2020. So everyone was confident that the market was heading to the moon and would never stop. It's hitting all-time highs right there. However, at that time, let me change this so you can see what's behind it. At that time, and I pointed this out, I first started doing the calls with Zuber at this point, December of 2021. So here's what it looked like after that. Well, hold on. Here's what it looked like after that time. if I can get this to change color, there we go. That's better. So you can see what happened. Market continued higher in the month of December. It broke through these November highs and had a little bit of a pullback and continued up to all-time highs once again. So the all-time closing high was 47.96. The intraday high was 48.18. That was that point right there. You can see the trend in December was up. But let's take a look at the intra-market indicators. This is where we compare different parts of the market to each other. So this is discretionary versus staples. Even as the market was hitting all-time highs in December, this was hitting lows. The Qs, this is NASDAQ versus the S&P, same thing, was hitting lows. This is technology versus the S&P. Now, I take it right down to the first of January. So it went all the way up in January. So where this green line is really the first couple of days of January. Market kept going higher. These all kept going lower. Growth versus value continued lower. Advanced decline line actually advanced higher because the market was going higher. But look what happened right after that in January. The market started to sell off. And everyone wasn't sure if that meant it was going to continue or if it would go back up, just like with these sell-offs, go back up and make all brand new highs again. However, the intra-market indicators accelerated to the downside. Not only did they go down, they went down even faster. But the most important thing is this December timeframe. The market was going higher, mostly on retail traders who were sure that it would never stop going up, while big Wall Street traders were rotating out of discretionary and into staples, out of aggressive sectors and into defensive sectors, out of technology and into large cap, out of growth and into value. The big traders on Wall Street were preparing themselves for the big, huge downtrend in 2022, which is what happened. And that's the thing, that's the kind of thing that I want to look for. I want to look for when the market is making new highs. What are these things that are under the covers? What is Wall Street doing? Where are they putting their money? So let's take a look now at where we are right now. So this is exactly as of Friday. This is 2023. So November, we continue to make new highs. And I'll go back here. Hang on. Back here. So you can see in this case, it was October to mid-November was making new highs. Right now, it's end of October. So we're a little bit ahead of what 2021 was. But what I want to see is, are these intra-market indicators also making highs, or are they starting to make new lows? As we're hitting new highs right here, and if we continue to go higher, the discretionary versus staples is clearly making new highs. That one is not reversing like it did in 2021. From the point of this uptrend right here, not only is the Qs, the technology, and the growth making new highs, but they have continued to make new highs even as the sell-off had continued back in September and October. So as the market was selling off, the only one that also went down was the XLY versus the XLP. The only one that went down was discretionary versus staples. The other ones were going up at the same time the market was selling off. That is a positive divergence. That's an indication that this downtrend was not going to last. So these were making new highs, but as this started to go up, they continued to make new highs, and that's what you want. You want to see these continuing to trend higher as the market trends higher. However, take a look at what's happened ever since the middle of November, when the market continued to go up and made higher highs. Even though it sort of went sideways, it still made some higher highs. But these very slightly started to make lower highs. So what does that mean? Is that an indication that the market is ready to roll over? and start heading back down like it did in 2021? We don't know. Nobody knows that yet. Now, the discretionary versus staples is very positive, but we have to keep an eye on these. If these don't break through that trend, in other words, if this continues to go higher and these continue to go lower, then that's an indication that Wall Street, big traders on Wall Street are rotating out of aggressive sectors and into defensive sectors, even as retail traders keep pushing the market higher. Now, I've been saying that we need to see a pullback. It would be healthy for a pullback. And this is the reason why. If the pullback occurs and these go down, that's the way it normally should be. These should go down as the market's pulling back. So you don't want to see them going down as the market's going higher. So if the market does go higher into the end of the year, I want to see these break through these trend lines. I want to see these go higher as well. So the next couple of weeks, we've basically got 2 weeks until Christmas. 2 weeks from tomorrow, I think, is Christmas. And then the Santa Claus rally will be in full swing. I'll be tracking that. We want to see if these indicators continue to go higher, these aggressive versus defensive areas. If they don't, if they start going lower, then I will be very concerned about this rally continuing into next year. It might continue for a week or two in January, but it could very easily after that take a big plunge. So this is what I'm watching. We have to be careful. That doesn't mean it's about ready to crash, but it is a caution signal right here, something that we want to watch. So that's it for today. Hope everyone is doing well. Happy trading next week. The website, and I will fix this newsletter link. I'm not sure why it's going to last week, so I'll make sure that that's fixed. But you can just go to the homepage and sign up there if you want to. And happy trading, everyone. Hope everyone has a great week. Take care.